Brad Williams, Frugal Finance, Bonds. Beginner's Guide Overview, the essentials of bonds. Bonds and bond funds can help diversify your portfolio. Bond prices fluctuate, although they tend to be less volatile than stocks. Some bonds, particularly U.S. Treasury securities, come with relatively lower risk and can help preserve capital and potentially generate income. When interest rates rise, bond prices tend to fall and vice versa. FINRA's fixed income data offers an easy way to find bond facts, including real-time data on corporate and agency bonds and important educational information. Debt securities, also known as fixed income securities, are financial instruments that have defined terms between a borrower, the issuer, and a lender, the investor. Bonds issued by a corporation, government, federal agency, or other organization to raise capital are a common type of debt security in which the borrower agrees to pay interest in exchange for the capital raised. The vast majority of bonds have a maturity date that's set when the bond is issued. On a bond's maturity date, the borrower fulfills its debt obligation by paying bondholders the final interest payment and the bond's face value, called par value. Generally, a bond that matures in 1 to 3 years is referred to as a short-term bond. Medium or intermediate term bonds are generally those that mature in 4 to 10 years, and long-term bonds are those with maturities greater than 10 years. Not all bonds reach maturity. Callable bonds, which allow the issuer to retire a bond before it matures, are common. A bond's coupon, or annual interest, is generally paid out semi-annually. The coupon is set at issuance and tied to the bond's face or par value. It's quoted as a percentage of par. For instance, a bond with a par value of $1,000 with an annual interest rate of 4.5% has a coupon rate of 4.5%, $45. An investor in a bond with a $45 annual coupon that pays interest semi-annually can expect to receive $22.50 interest payments twice per year. Bottom line, bonds and bond funds can be an important component of a diversified investment portfolio. They can be helpful for anyone concerned about capital preservation and income generation, and can help partially offset the risks that come with equity investing. Well, like all investments, they also carry an element of risk. Comment if you have any questions related to bonds. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.